Hello and welcome back to the Commodities Institute podcast. It is Tuesday, April 7th, 2026. I am Emily Costa, and today we're looking at a global market that is quite literally under fire. We are 5 weeks into a conflict that has redrawn the map of commodity flows, creating a world of winners and losers defined entirely by their physical geography and their access to alternative routes. We begin today with the metals markets, where traders are waking up to a reality they simply did not project at the start of the year. While everyone was watching copper, it is aluminium that has stolen the headlines. The war in the East has exposed just how fragile the Western supply chain truly is. The Gulf region accounts for nearly a fifth of all global aluminium exports outside of China, and that supply is currently being decimated. We have seen the giant Al-Taweelah smelter in the United Arab Emirates go completely out of action after its power plant was damaged, while over in Bahrain, the Alba smelter is operating at only 30% capacity following missile strikes. This has created a double blow for buyers. Not only are the base prices on the London Metal Exchange hitting 4-year highs, but the physical premiums, the extra cost to actually get the metal delivered, have jumped significantly. Meanwhile, copper is telling a very different story. Despite hitting record nominal highs in January of over $14,500 per tonne, the market is actually sitting on a mountain of surplus metal. Exchange stocks are at multi-year highs, which has sucked the oxygen out of that early year speculative rally. Moving to the power and gas sector, the situation in the Strait of Hormuz remains incredibly volatile. We just received reports that Iran's Revolutionary Guards halted 2 Qatari liquefied natural gas tankers on Monday morning. These vessels, the Al Dayen and the Rashida, were supposed to be the first LNG cargoes to transit the waterway since the conflict began in late February, following a deal mediated by Pakistan. Instead, they were instructed to hold their positions without explanation. Goldman Sachs is now warning that European gas prices might be underestimating the danger here. While Europe's imports have stayed resilient for now, that is largely because Chinese demand has been weak due to weather and price sensitivity. If China's demand recovers while 19% of the world's LNG remains trapped or disrupted, we could see European prices test much higher ranges, potentially reaching 75 to 100 euros per megawatt hour. Turning our attention to agriculture, Beijing is moving with a sense of urgency we haven't seen before. On the floodplains northwest of Shanghai, farmers are being pushed to feed their pigs a new menu. Feed accounts for 70% of the cost of raising a pig, and with soybean prices becoming wildly unstable due to the trade standoff with Washington and the war in the Middle East, China is trying to break its addiction to imported soy. They are using fermentation technology, think of it like making yogurt for livestock, to break down proteins in cheaper local ingredients like brands and pumpkin vines. This isn't just a grassroots move. It's a strategic national policy equivalent to their push for domestic microchips. They've already managed to cut the soy meal content in some feeds from 10% down to just over 7%. On the fertilizer front, China is sitting in a unique position. While the rest of the world is seeing urea prices surge 70% because 30% of the global trade is stuck behind the Hormuz blockade, China produces most of its fertilizer using its vast domestic coal reserves. This insulates their farmers from the natural gas price spikes affecting Russia or Saudi Arabia, though the government is likely to keep a tight lid on exports to keep local prices low. Finally, we look at the oil markets, where the closure of the Strait of Hormuz is creating a massive divide in the fortunes of Middle Eastern states. It's a game of pipelines. Iran, Oman and Saudi Arabia have seen their revenues rise because they either control the waterway or have invested in massive infrastructure to bypass it. The Saudi East-West Link, a 1,200-kilometre pipeline built back in the 1980s, is currently running at its full capacity of 7 million barrels per day, shipping crude out of the Red Sea port of Yanbu. Because of this, Saudi oil revenues actually increased by over $500 million compared to last year, even though their total export volumes fell. On the other side of the ledger, countries like Iraq and Kuwait are in a dire spot. Without alternative routes, their oil is effectively trapped. Iraq's revenues plunged by 76% in March, and Kuwait followed with a 73% drop. Over in the United States, President Trump has waived the Jones Act to allow foreign ships to move fuel between domestic ports, hoping to lower prices at the pump. However, the data shows this hasn't really worked. American refiners are making much higher profits shipping fuel to Asia and Europe, where the Middle East war has created a desperate shortage. Consequently, US fuel exports hit a record high last month, while domestic flows remained flat. It is a complex, interconnected web of disruption, from coffee exports in Honduras jumping 30% to Panama finally moving to release stockpiled copper ore from the shuttered Cobre Panama mine. Every corner of the commodities world is reacting to this crisis. If you found this episode valuable, be sure to subscribe, share, and leave a review. Find us online at commoditiesinstitute.com.